Hi, this is Phil Franks again from the Franks Report. I am the founder and creator. I just got back from the dog park with my dog. He loves doing that. He was itching to go. So we finished that and we're back. Uh, let's see. This is off the charts or away from the charts, my segment that I do, where I talk about market things, concepts for retail traders and just have an honest conversation. There's no paywall here. There's no tricks or gimmicks. We're just gonna talk about things that can help retail traders. And I've explained in other videos and website and all other stuff that I used to be an institutional trader. I was a financial advisor for a well-known firm, and I switched over to retail trading. And now I do this. So let's jump right in. So I've touched on a number of topics in the past 5 videos or so. And in this video, I want to talk about setting up your brokerage platform. And I've seen a number of them that people have put together. And it looks like something from, Star Wars or something. There is way too much going on. It looks like you're trying to zero in and target something that you're going to attack or shoot. It's too much. I'll be honest with you. There's been times where I've just traded just straight price action, where I just watch the candlesticks form on the chart in real time and make trades based on that. So it's totally something you can do. You don't need 1,000 indicators on, 4 charts covering the same asset and all these crazy math formulas. They're great. There is a purpose and a reason for them, but it gets to be kind of a lot, and I think people overdo it because they're trying to find the sure thing when they are placing trades. And especially when they're new, there's a lot of fear, I think, involved and anxiety. And so they're trying to make up for their lack of experience and knowledge by using these tools. And unfortunately, when you do this, it actually makes it worse more often than not. And it confuses them, and then they end up, failing prop firm challenges or, losing money in their own personal accounts. So, all right. So I think the first takeaway is simplify your chart. You do not need 4 charts of the same asset. You don't need multiple indicators overlaying to the point where you can't even really see the price action that's going on in real time. It's too much, and you let your strategy dictate what tools you need. If you are the kind of trader that relies on confluence, you want at least 2 to 3 indicators, or whatever you're using to agree on a situation before you pull the trigger on a trade, then use those indicators that lend itself to it. What have you decided are the signs that say, hey, when these 2, 3 things or whatever agree, this is when I want to go long or go short. That is how you design your charts, around that. But before we go to that, let's go back a little further. First, when you get a brokerage account, oftentimes there is a default chart that it goes to. My recommendation is just to clear all that stuff out. Clear it all out. Just get rid of it, all of it. You don't even need 80% of it. Hey, my dog wants to join. Hello, Cheerio. Hi, buddy. I know. Okay. Who's a beautiful boy? Yes, sir. Yes, sir. That's you. So yeah, go ahead and clear out, it's probably at least 80% of that stuff. And you'll oftentimes just be left with just a simple chart, just a single chart, and that's perfect. You need the chart, and here's the thing. Depending on your strategy will determine what intervals, what time interval you need to have the asset tracing at. So whether it be, if you're a scalper, obviously the 1 minute chart, 5 minute charts. If you're looking more long term or like structural, if you're trying to find out, what's the ceiling and the floor of this thing over X period or whatever, you're looking at 4 hour charts and back, things like that. So depending on what you're trading and depending on your strategy, will dictate the time interval for your asset that you're trading. After that, you definitely want to use candlesticks. And candlesticks, they're not just like a line, like, oh, it's going up, it's going down. It'll actually show you, what is happening between the buyers and sellers and who has control. And you can do better trend analysis using candlesticks. It also gives you an idea for the range. What was the range during this time interval? At the low range, and the high range, things like that. And so using candlesticks is basically best business practice. Everyone who's anyone uses candlesticks. Okay, so to go ahead and do that. After you've done that, you got your chart set up. You got your time interval that you need to make decisions. And you can have a second chart. So like, let's say you're tracking the 1 minute and the 5 minute, both. And you can have two charts, 1 minute, 1 5 minute, I guess, and see what the trend looks like overall. But I wouldn't get too crazy with it. And as far as indicators, there are some really sophisticated ones. And I think there's specific use cases for those, in general, having a moving average of some kind, some kind of EMA, it helps at least give you an idea of how, how the trading, should follow, or is trending. And also there's VWAP, that's another one that's pretty decent. It's the volume weighted average, and it can give signals to buy or sell depending on where the things are trading. And there are RSI, relative strength index, that basically will show, well, the way it's supposed to work is it'll show you when purchasing power is starting to exhaust, or when selling pressure is starting to exhaust, and where they are and things like that. So they're real simple, nothing fancy, not like some of these other ones that, clearly made by mathematicians and, PhD types are doing some crazy stuff with math for, I think, deeper analysis and things like that. But when you're doing like day trading, stuff like that, those more sophisticated tools are good for, when you back test and look at stuff, and you're trying to determine trends and how they might place on future trades, things like that. But in the moment, in real time, you probably don't need to do all that, because before you even hit the charts, you need to have understanding of what's going on at the macro level, world events, domestically, what's driving price action, before you look at some of the technical things that's driving price action. So, just be mindful of that. Don't treat the indicators and other tools as the be all do all, because just because something is technically sound, or it's fitting a certain technical mold on the chart, doesn't mean it's going to continue that way when there are other external factors that will dictate market movements. So like if the president makes an announcement or something like that, you have to adjust for that. You have to look at the whole picture. So that's the reality of those types of things. So, bottom line, when you set up charts, simple is better. The KISS method, keep it simple, stupid. It'll be so much easier to read, so much easier to make decisions. And just remember that however you set up your charts, that it follows your strategy. Let your strategy dictate how you put your charts together. Don't listen to somebody on YouTube or see something on Google that says, these are the indicators you must have. I just listed those few just so you have an understanding of some, common ones that people will use that are pretty simplistic. They're not advanced by any means, and there's even variations on those. that are more advanced. So, having, 1, 2, 3 indicators at most, I can see that. But having, I've seen some where they're showing the volume, the RSI, VWAP, variations of EMA. Good Lord. There are, I'm trying to think of some other ones off the top of my head, but they layer so many that it's too much. And here's the truth that people don't realize is that indicators always lag price action. What is happening right now on the chart is what's happening right now. And all those formulas that output those indicators, they have to wait for the price action to print first before it can calculate and then show output for the indicators. So because of that, indicators will always lag behind real time. And so, you have to think about these things, because by the time maybe the indicator based on your strategy says, okay, this is a executable moment, like we need to move now. But in reality, the chart has already done something drastic. There's, let's say you were going short and all of a sudden there's a God candle that just blows to the ceiling. And now all of a sudden, it's hit your stop loss, a million miles ago. So you have to make sure that when you're using indicators, you're paying attention to reality and looking at the immediate price action and comparing those two, so that you're not caught off guard, because it can very easily happen. There's a million stories about it. People just, hey, I failed my prop firm challenge. I, hit my daily loss limit, whatever, blah, 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 blah. Don't be that person. So that's all I really want to say about charts. Just keep it simple. I may have to put up a video of actually building a chart. Each platform's different. We're using like NinjaTrader, Trade of 8, some kind of rhythmic charting, and there's a bunch, and they each have their pros and cons. Some do things better than others, but as far as the fundamentals, if you stick to the fundamentals, just replicate that from whatever charting system you're using, and you should be okay. That's all I got for right now. There are a million other things we can talk about, but my dog is getting antsy and he wants me to play fetch. So thank you for listening. I hope this was helpful for, obviously it's more for beginner traders, but even those who have traded for a while and just gotten to the bad habit of just like putting too much on the charts, trying to find that perfect window. It doesn't work like that. It just doesn't. You can't target dead on like that. Sometimes we get lucky, but that's just not how that works. So if you need to hear that again, because you're still that person who's still hanging on to a million indicators, let me tell you again, stop, don't do it, simplify it, and it'll be a little easier for your brain to manage that so you can execute manually. And that leads to a different discussion about, obviously you can get away with more indicators for doing automation because there's no human component there. But anyway, take care. And remember, trading is risky. My dog says hi. And we'll see you on the next one. See ya.